So there you are, sitting at a kitchen table that has seen better days, staring at a glossy brochure that looks way too expensive to be free. Across from you is a guy in a suit that costs more than your first car. He is smiling, he is friendly, and he is telling you that he has the secret to not just protecting your family, but beating the banks, becoming your own source of financing, and retiring with tax-free wealth. He is talking about infinite banking, paid-up additions, and tax-free growth. And you are sitting there thinking, this sounds amazing. But is it? You feel that little tug in your gut, the one that says if something sounds too good to be true, it usually is. But he has got charts. He has got math. He has got a highlighter. And honestly, that is the exact moment where most people make a mistake that costs them hundreds of thousands of dollars. They get confused by the complexity, they trust the suit, and they sign on the dotted line for a whole life insurance policy that they think is an investment. My name is Jack, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth, while others stay stuck in the same financial patterns for decades. And I have to tell you, nothing twists people into financial knots quite like the debate between whole life and term insurance. It is a religious war in the finance world, and the craziest part is that the answer is actually simple math. Not the confusing math the agent shows you with the highlighter, but the real math. Today, we are going to look at the numbers, the psychology, and the hard truth about where you should actually put your money if you want to get rich. Because once you see the real math on how these two products perform over a lifetime, you are never going to look at a life insurance policy the same way again. All right, let us start with the basics because, honestly, the entire industry relies on you being slightly confused about the definitions. If you understand the mechanics perfectly, the magic trick stops working. So, what are we actually looking at here? On one side, you have term life insurance. This is the boring stuff. This is pure protection. You pay a monthly premium, let us say $50, and if you die within the term, usually 20 or 30 years, the insurance company cuts a check to your family for $1 million. If you do not die, they keep the money, and the policy expires. It is like car insurance for your life. You do not expect to get money back when you do not crash your car, right? It is just peace of mind. On the other side, you have whole life insurance. This is permanent insurance. It is designed to last until you die, whenever that is, as long as you pay the premiums. But the selling point is not just the death benefit. It is the cash value. The agent tells you that part of your premium goes into a savings account inside the policy that grows tax-deferred and earns dividends. They sell this as a retirement vehicle, a way to bank on yourself. You can borrow against this cash value later for emergencies or to buy a car. So, on the surface, it sounds like a no-brainer. Why would I just rent my life insurance with term when I can buy it and build up an investment account with whole life? Why throw money away on premiums if I can have a forced savings plan? Here is the thing. That logic works perfectly, assuming the costs are equal. But they're not. And that is the trap. Let us talk about the cost of admission. I pulled some real numbers for a healthy 30-year-old male looking for $1 million in coverage. For a 20-year term policy, you are looking at roughly $40 to $50 a month. It is cheap. It is accessible. For a whole life policy with that same $1 million death benefit, you are looking at anywhere from $800 to $1,200 a month. Sometimes more, depending on the specific structure of the policy. We are talking about a massive difference in monthly cash flow. We are talking about a difference of, say, $1,000 a month. That is $12,000 a year. That is a real, tangible chunk of money that you have to earn, get taxed on, and then send to an insurance company. Now, the agent is going to lean in across that table and say, yes, but you are building equity. You are not just spending it. You are saving it. And they are technically right. A portion of that massive premium does go into the cash value. But they do not like to talk about what happens in the first few years. It is something called the front-loading of fees. See, with whole life insurance, a huge chunk of your premiums in the first 3 to 5 years goes to pay the agent his commission and the insurance company his administrative costs. I am talking like 80%, sometimes even 100% of your premium in year one. If you pay $1,000 in month one, your cash value might increase by $0. You just paid $12,000 for the first year to effectively have a savings account balance of $0. It feels like a scam when you say it out loud, but it is legal because it is disclosed in the tiny print of a 50-page document nobody reads. They call it building the reserve. I call it a drag. So let us run the simulation. This is the real math part. This is where we stop listening to the highlighter and start looking at the spreadsheet. We have two people. Let us call them Term Tom and Whole Life William. Both are 30 years old. Both have $1,000 a month to allocate toward protection and savings. This is the key. You have to compare apples to apples based on the budget, not the policy face value. Term Tom buys a 20-year term policy for $50 a month. That leaves him with $950 a month to invest. He decides to invest that in a low-cost S&P 500 index fund. Historically, the market has returned about 10% a year on average before inflation. We will use that number. We will assume he is disciplined. He just automates it and forgets it. Whole Life William buys a whole life policy. It costs him the full $1,000 a month. He has zero cash left over to invest elsewhere. He is putting everything into the policy. The insurance company guarantees a growth rate on the cash value of maybe 2% to 4%, plus dividends, which are not technically guaranteed, but historically have been around 5 to 6% for some mutual companies. Let us be generous and give William a steady, conservative 5% average growth on his cash value. Fast forward 10 years. Tom has been socking away $950 a month into the market. The market has had its ups and downs, but it has grown. He has put in about $114,000 total. His account balance? Roughly $190,000 to $200,000, depending on the exact years. William, on the other hand, has paid in $120,000. But remember those front-loaded fees? His cash value is likely sitting around $80,000 to $90,000. He has put in more money than Tom, but he has less wealth. He is underwater. And he cannot just take that money out without tax consequences or loan interest if he borrows against it. Tom, if he needed that money for an emergency, could sell his stocks and pay capital gains tax, or he could have kept an emergency fund separate. Tom is winning, and it is not even close. Let us jump to year 20. This is a critical milestone. This is where Term Tom's policy expires. He is now 50 years old. Tom has invested $228,000 of his own money over 20 years. With average market returns, his portfolio is now sitting somewhere around $700,000 to $750,000. That is real wealth. That is a retirement nest egg that is compounding furiously. What about William? He has paid in $240,000. His cash value has finally started to pick up steam because the commission fees are gone. He might have a cash value of around $180,000 to $200,000. So, after 20 years of paying the same monthly amount, Tom has over $700,000 in liquid, investable assets. William has $200,000 trapped inside an insurance policy. The difference is staggering. We are talking about a gap of $500,000. Now, the agent will pivot here. They will say, but Tom's insurance is gone. He is 50, he might be uninsurable now, and he has no death benefit. And that is a valid concern. Term insurance expires. That is the deal you made. But here is what nobody tells you. Tom has $750,000. He can self-insure. If Tom dies at 51, does his wife need the $1 million check? Or does she just need the $750,000 investment account plus the life insurance? Or, frankly, Tom could take a tiny fraction of the gains from that investment account and buy a new term policy, or even a smaller whole life policy now that he is older, if he really wants to leave something behind. William, on the other hand, still has that $1 million death benefit. But to keep it, he has to keep paying those massive premiums, potentially for the rest of his life. If he stops paying, the policy lapses and he loses the death benefit. If he surrenders the policy to get his cash value out, he loses the insurance. He is trapped. This brings us to the psychology of the bank on yourself concept. This is the sexiest part of the whole life sales pitch. They tell you that you can borrow against your cash value to buy cars, start businesses, or pay for college, and that the loan does not affect your credit score. They say you are paying yourself interest. It sounds empowering. You become the bank. But let us look at the mechanics of that. When you borrow from your whole life policy, you are taking a loan from the insurance company using your cash value as collateral. The insurance company charges you interest on that loan. Let us say it is 5%. Meanwhile, your cash value continues to earn dividends at maybe 5%. So they sell it as a wash. You borrow your own money, pay it back, and your account keeps growing like you never touched it. Here is the hidden cost. You are paying 5% to borrow your own money. That is a drag. If Tom wants to buy a car, he takes $20,000 out of his index fund. He stops earning returns on that $20,000. That is his opportunity cost. But he pays zero interest to a bank. He just spends his money. William wants to buy a car. He borrows $20,000 from the insurance company. He pays them back $1,000 a year in interest. Over 5 years, that is thousands of dollars in fees he would not have paid if he just used his own cash. And the insurance company keeps that interest. Now, proponents argue that because your money stayed in the account earning dividends, you did not lose any ground. But you paid interest out of your pocket. Where did that interest money come from? It came from your budget. It came from money you could have invested. It is a shell game. It feels sophisticated, but mathematically, it is almost always inferior to simply having liquidity in a taxable brokerage account or a savings account. I want to take a second here to just vent a little bit, because it really frustrates me. The reason whole life is sold so aggressively is because it pays incredibly high commissions. A term policy pays the agent maybe a one-time commission of 30% to 50% of the first year's premium. So on a $50 monthly policy, the agent makes maybe $300. That is not a living wage. On a whole life policy, the commission can be 80% to 100% of the first year's premium. On that $1,000 a month policy, the agent makes $12,000 in year one. And then they make trailers or renewals for years to come. Do you think an agent is going to recommend the product that pays them $300 or the product that pays them $12,000? They are not necessarily bad people. Many of them truly believe they are helping you. But they are viewing your financial life through the lens of how it pays their mortgage. That bias is invisible to them, but it should be blindingly obvious to you. Okay, let us look at the long game. Let us say we fast forward all the way to age 65, retirement age. Term Tom. He stopped paying insurance at 50. From age 50 to 65, he kept investing that $1,000 a month because he never got used to spending it. He has been investing for 35 years total. His math looks like this. He contributed roughly $420,000 over his lifetime. With 10% average returns, his portfolio is now worth roughly $3.8 million. Whole life William. He has been paying $1,000 a month religiously for 35 years. He has paid in $420,000. He has a cash value of maybe $450,000 or $500,000. And he has a death benefit of $1 million. Now William can retire. He has access to that cash value. He can take tax-free loans against it to live on. That sounds nice, but he is living on a few $100,000. Tom is sitting on nearly $4 million. Even if Tom pays taxes on his withdrawals, a 15% capital gains tax, he is miles ahead. Tom can live on $150,000 a year and barely touch the principal. William is going to burn through his cash value in a few years. The only way William wins is if he dies early. If William dies at age 55, his family gets $1 million tax-free. Tom, at 55, has maybe $1.2 million or $1.5 million in his investment account. So in the event of an early death, they are roughly equal. But here is the question you have to ask yourself. Are you buying insurance as an investment for yourself, to use while you are alive, or are you buying it as a lottery ticket for your family if you die young? If you are wealthy and you have maxed out every other tax-advantaged account, your 401k, your IRA, your HSA, and you have millions of dollars you do not know what to do with, then yes, whole life insurance can be a useful estate planning tool. It can help pay estate taxes, so your heirs do not have to sell the family business. That is a legitimate, high net worth strategy. But for the average person watching this video, for the person trying to figure out how to pay off the house, save for college, and retire with dignity, whole life is a terrible wealth-building tool. It is a wealth transfer tool. It transfers your wealth to the insurance company and the agent. The math is brutal. The opportunity cost is astronomical. And yet, I know people are going to go to the comments and say, but Jack, the market is not guaranteed. The market could crash. Whole life has guarantees. You are right. The market does crash. But it recovers. In 2008, the market dropped 50%. By 2012, it had made new highs. If you sold at the bottom, you lost. If you held, you won. Whole life guarantees you will not lose your principal, but they also guarantee you will not beat inflation by much. You are guaranteed to be poor slowly, rather than potentially be rich quickly. I would rather take the risk of volatility to have the chance at $3.8 million than take the guarantee of $500,000. Let us talk about the behavioral gap. This is the one defense the whole life agents have that actually holds some water. They say, Jack, your math assumes Term Tom is a robot. Term Tom is a human. Humans are not disciplined. If Tom has $950 a month left over, is he really going to invest it? Or is he going to buy a boat, go out to dinner, and upgrade his car? This is a fair point. The buy term and invest the difference strategy requires discipline. It requires you to be the adult in the room. Whole life is a forced savings plan. If you stop paying, you lose the insurance, so people are more likely to keep paying. If you know yourself, if you know deep down that you cannot be trusted to save that extra money every month, whole life is better than nothing. Something is better than nothing. A mediocre savings plan is better than no savings plan. But here is the counter-argument. Why not automate the investing? Set the $950 to come out of your paycheck the day you get paid, before you ever see it. Put it in a target date fund you cannot touch without penalty. Use the behavioral psychology of automation to force yourself to be disciplined. You do not need to pay an insurance company thousands of dollars a year to be your parent. You can be your own parent. Another point people bring up is taxes. Whole life cash value grows tax deferred, and you can borrow against it tax-free. Tom pays capital gains tax when he sells. This is true, but the tax drag on a broad market index fund is low because you are not selling until retirement. You let it grow. Even if you assume a 15% tax hit at the end, the net result of the index fund is so astronomically higher than the whole life policy that the taxes do not even close the gap. It is like complaining about the price of gas when you are driving a Ferrari versus taking the bus. The Ferrari costs more to run, but it gets you there faster. So where does this leave us? What is the verdict? If you look at the real math, the winner is undeniable. Buy term and invest the difference is the superior wealth building strategy for 99% of the population. It keeps your costs low, maximizes your growth potential, and gives you liquidity and control. The allure of whole life is that it feels safe. It feels like a magic bullet. It is sold by charismatic people who tell you what you want to hear, that you can have your cake and eat it too, that you can have insurance and investment and loans and tax-free living all in one shiny package. But life is not a shiny package. Real wealth building is boring. It is slow. It is about keeping costs low, taking calculated risks, and having the discipline to delay gratification. I want you to imagine yourself at 65. You are looking at your bank account. Which number do you want to see? Do you want to see $500,000 that you have to borrow against? Or do you want to see millions of dollars that you own free and clear? The choice is yours. The math is the math. Do not let the suit with the highlighter confuse you. Go get yourself a term policy. Level term, 20 or 30 years. Make sure it is 10 to 12 times your income. That is your safety net. Then take that massive difference in premium, money you were probably going to waste anyway, and put it to work. Buy index funds. Buy real estate. Start a business. Invest in yourself. Stop trying to beat the system with complex insurance products. The system is designed to take your money. The way to win is not to find a trickier product. It is to keep more of your money and let compound interest do the heavy lifting. I know it is not as sexy. There is no glossy brochure for spend less than you make and by VTI. It does not sound like a secret, but that is the secret. The secret is that the boring road is the one that actually leads to the mansion. You have the information now. You have seen the numbers. You have seen the commissions and the hidden fees. You cannot say you did not know. So, the next time you sit down across from that agent and they slide that brochure across the table and they smile that practiced smile, you can smile back. You can look them in the eye and say, show me the math on the term policy. And then you can take the difference and you can build your own empire. That is how you win. Now look, I know this was a long deep dive. I know we covered a lot of ground, and if your head is spinning a little bit, that is okay. This stuff is designed to be confusing, but the core principle is simple. Do not mix your insurance with your investments. They are two different tools for two different jobs. Insurance is for protecting your family from a tragedy. Investing is for building a future of abundance. When you try to mix them, you end up with a mediocre insurance policy and a terrible investment. My hope for you is that you leave this video feeling empowered, not guilty. If you already have a whole life policy, do not panic. It might not be the mathematically perfect choice, but it is not the end of the world. You have options. You can surrender it, you can sell it on the secondary market, or you can just keep it and focus on doing better with your other money moving forward. The past is the past. The only thing that matters is what you do with your next paycheck. Start asking questions. Demand to see the numbers. Run the spreadsheet yourself. Stop trusting blindly and start thinking critically. Your future self, the one relaxing on the beach or playing with grandkids without worrying about money, will thank you for it. You have got this. It is just math. And math is on your side if you let it be.